Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome. This is Richard Benuli of the FRA. Welcome to the Roundtable Insight discussion, where we discuss a number of the key topics of the week. Today, we have Danielle DiMartino Booth, who has spent the better part of a decade advising Dallas Federal Reserve President Richard Fisher on monetary policy and the financial markets. She now runs an economic consultancy, Money Strong LLC, where she writes a widely followed newsletter on what the future holds given the uncharted waters in which we now find ourselves with central bankers more powerful than any politician in the world. Welcome, Danielle.
Thank you so much for having me today.
Great. We thought we'd begin with a recent essay that you did called The Overlords of Finance. And if you'd like to give us a bit of background on that and what you were trying to accomplish in terms of the message.
So just by way of a little bit of background, one of the greatest influences on my personal literary career and my knowledge of the Fed, I think a lot of people used to go off of The Creature from Jekyll Island. For me, it was always the Lords of Finance. So it described an era beginning prior to World War I and through the Great Depression and World War II, when central bankers assumed more power than politicians. And as we know, that era did not end well at all. And the parallels between then and now are striking, and they're what encouraged me and inspired me to write The Overlords of Finance, which has been very well received, in fact, worldwide, because I think it's a message that resonates as we watch one election return after another come in, where it's quite obvious that a lot of the populations of the world feel that central bankers have overstepped their mandates, they've overstretched their reach, and they've made life worse for the majority of the people over whom they rule effectively.
And in what ways is that, would we consider like the increase in wealth, income inequality, some of the unintended consequences? Could you elaborate?
Look, take one example. No, take two examples. In the aftermath of Trump's election, there's been a lot of cheering about pushing back some of the Obamacare regulations. And it was interesting. I was listening to some exit polling out of Ohio, and these were small businessmen who were saying, it's become impossible for us to conduct business. Well, in the event you think that I've lost my marbles or I'm being too circumspect, if the United States government hadn't had 1.8% borrowing costs for as long as it has care of zero interest rates, then I venture to say that have passed the Affordable Care Act as easily as it did, because they would have had to have weighed more cautiously the costs and the benefits. A separate example, if I could continue,
go ahead.
Is that zero interest rates led to a very untenable situation in housing. If you look at housing today, it's more expensive to rent and buy than in any other time since the housing bubble years, which means that if you're a hospital worker in downtown Dallas, even here in Dallas where I live, you're talking about an hour and a half to a 2-hour commute. Ridiculous. Just to be able to move far enough out to get affordable housing. So had we not been in a period of too low for too long, and of course I receive, I refer to interest rates, then we wouldn't have had apartment builders, and we wouldn't have had home builders only build luxury homes because that's the only thing that they could make work in a zero interest rate environment. So these are unintended consequences of Fed policy. But you have to start wondering at some point if they're blind or cruel. If they're blind, that's not good. If they're cruel, that's even worse.
And yeah, not to mention the effects on savers, pension funds. I think you had an article on that as well, in terms of how it's becoming a challenge for them to get yield.
That's a whole different. And you know what? I won't even call that one unintended. If you look back at the transcripts from December 2008, when the Federal Reserve lowered interest rates to the zero bound, this is something I cover in my upcoming book. The attitude in the room was, yeah, we understand that there's going to be some losers, but we're right. Let's just push ahead. And there were a few voices, Charlie Plosser, my former boss, Richard Fisher, who were saying, wait a minute, are we not taking into account the terribly debilitating impact that this is going to have on retirees who can no longer be prudent in their investment allocations? I joke tongue-in-cheek that we forced grandma to go to Vegas by making her buy junk bonds, but it's the truth. And this is in an environment where we've been in a 35-year-long bond bull market. Imagine what happens to these retirees' bond holdings if bond yields continue to rise as they've been of late.
Exactly, and also, not to mention overcapacity, overbuilding in different markets, in the commodity markets. With energy, with regards to energy and the Bakken. That has also the low interest rates has fueled that type of behavior as well. Would you not agree?
Yes, I would agree. And the shame of it is, this is not malinvestment in the traditional von Mises Austrian way, because this was technology that should have been pursued, and it will make extracting energy that much less expensive going forward. There was just too much of it. We pushed too much money into the industry, and it should have been spread out over a long period of time, which I think would have prevented the bust that we've seen in that industry. So it's not traditional malinvestment, but it is an outgrowth of central banking policy gone wild.
And would you say also that there's an element by governments to keep interest rates low in order to help the financing of massive debt and deficit spending, because of the fact that if interest rates were to rise, that would cause devastation in the bond market? We recently did a calculation in terms of what level of interest rates could rise for a sustained period of time in the U.S., and we came up with a figure of about 5.3%. Actually, this is a little while ago compared to what the rates are now, but if interest rates were to rise on the 10-year to normalized rates in the 7 or 8% range, we actually come up with and were to stay there for a sustained period of time to take into account the weighted average maturity of the debt. We figure there would be no money left from the U.S. federal government revenues to pay for entitlements, defense, welfare, government operations, National Park Service, SEC, White House operations, etc. All revenues would pay for the debt. Another way to look at it would be if interest rates on the 10-year were to rise to about 7.78% and stay at that level or higher for several years, the entire U.S. federal government budget, except for the interest on the national debt and losses on the Federal Reserve balance sheet, would need to be paid by money printing.
Well, I believe that. I don't think I would consider 7 or 8% to be normalized today. If that was to be sustained, you're talking about a global depression, period end. But even taking a more conservative tack, had interest rates been kind of closer to the 4% level, at a bare minimum, we would have seen the deficit that has been quote unquote, crashing under the current administration. It would have been double or more what's been reported. One of the most shocking things I've seen recently is that the deficit's going to rise in fiscal year 2017 for the first time. That's with interest rates where they are. So no, I definitely worry about the future solvency of the national government. And that's not even really taking into account Medicare and a lot of the quote-unquote off-balance sheet disasters.
And coming back to your essay on the Overlords of Finance, you mentioned the idea that QE being used to effectively cancel the debt, whether it be today or unfunded liabilities coming in the near future. Can you elaborate on that?
Well, so when you get to the issue of pensions, I think I think you get to one of the major sources of social unrest that we're going to have in the future. I think what's most broken with our pension system, and it's become more and more recognized, is the fact that we have these crooked rate of return assumptions. And I don't use the word crooked lightly. When I was in England recently, I was reminded by somebody there, a peer of mine, that by law, the rate of return assumption in Great Britain is capped at 3.5%. That way you don't tempt pension fund managers to go to the casino with retirees' money. It's exactly the opposite here. Even here in Texas, which is considered to be a fairly solvent state vis-a-vis the likes of Illinois, New Jersey, California. Even here, the largest pension fund has got a rate of return assumption that remains at 8%. So this era of low interest rates, not only has it forced liabilities themselves to balloon, but it's also created a risk vacuum and a liquidity vacuum in pension portfolios that's really going to come back to haunt retirees in the end. And I go so far as to say in subsequent writings that you will end up with social unrest when you start to cut things like police forces and firefighters and the number of ambulance drivers you have. You will have social unrest as a direct result of Fed policy. And I think there's a growing recognition of these factors in Great Britain. You've seen some open letters to the Bank of England. In South Africa, you've seen people rising up against their central bank there as well. And I think that the trend is going to continue as more of the damages that have been caused by this era of unconventional monetary policy are realized and start to trickle down to people and retirees.
Yeah, exactly. What about inflation, effects on inflation? So if we look at monetary stimulus from quantitative easing programs, as you mentioned in your essay, effectively canceling the debt, does that actually cause, or could that cause inflation in some way, or is that contained because it's not getting out into the banking system, it's being held as bank reserves? Can you elaborate on that?
Well, so I'm of a different school of thought, because I think that one of the things that people anticipate the least when it comes to the traditional triggers for inflation, because if traditional theories held, we should have skyrocketing hyperinflation by now in this country. What was not taken into account was China and the effect that a massive economy coming online would have in terms of driving deflationary sources that more than offset central bank action. So in a roundabout way, I will answer your question. As long as debt continues to grow worldwide, I think we'll keep a lid on inflation, because governments, entities don't have money to spend on other things as long as they have to keep servicing that debt. However, Chinese foreign reserves have started to decline, and they've started to decline in earnest. We've now with the latest monthly report out of China, we now know that they are at their lowest level since 2011, lowest level in 5 years. as the Chinese begin to burn through these reserves, and knowing what we know about the $3 trillion in reserves that they have, which is $1 trillion of it is earmarked to build this road to Europe, and they're dead set on doing this to guarantee their place in the world economy.
The Silk Road you're referring to?
Yes, yes.
Yeah.
So about $1 trillion of their reserves are earmarked to finance that.
Mm-hmm.
Another $1 trillion of their reserves are very illiquid in nature. In other words, they can't necessarily be accessed easily, which leaves them with $1 trillion. And what we know to be a black box of debt, an insolvent banking system, a property bubble that makes Japan circa 1989 look like a walk in the park. And you ask yourself, how long are they going to have that $1 trillion as a buffer? If you take that one step further, logically speaking, and we start to see fiscal spending here in the United States that continues to drive up the metals, which we've seen since they bottomed at the beginning of the year. Well, then the combination of foreign buyers stepping away, the deflationary impulses from overseas and globalization ebbing, and inflation at home, then you could flip a switch and it won't be pretty.
And would that be exacerbated by plans in the U.S., in Canada, and elsewhere in the developed world to go to fiscal stimulus in terms of government-sponsored infrastructure spending that would be direct infusion into the economy as fiscal stimulus versus monetary stimulus?
Oh, I think that look, I think there's always a danger when you go from one extreme to another. And, I think a watershed moment for the credibility of central bankers occurred when Japan implemented negative interest rates and it backfired. Mm-hmm. And that made all of the theoretical doves in the world, it got them all really upset, and rightly so. Because that meant that the onus was going to move from the all-powerful overlords of finance, central bankers, back onto government in the form of fiscal stimulus. But what happens when they all do it at the same time? Yeah. Well, then you get to your inflationary scenario playing out in a hurry.
And so is that what you see if we look out in the medium term, if we look at the trend in 10-year, 30-year U.S. government bond yields going higher, especially in the last 10 days or so since the U.S. elections, and even from September as a potential trend? Do you see that continuing? And also in terms of rising inflation, do you see that as a trend going into the new year?
It's all going to depend. I think it's a bunch of hooey to say that the Fed is not a political institution. And you can bet your bottom dollar they're none too excited about the new or soon-to-be occupant of the White House and the fact that he's got his sights set on them. So do they hike in December to spite him and to try and induce a recession on his watch and flip the 2018 midterm elections so you end up with Democrats controlling Congress again? Possibly. But I think they go in December. Then the question becomes one of, what does the yield curve look like? Has inflation continued to rise? Has the steepening continued, or given that this expansion is one of the longest in the teeth on record? Or what happens if it starts to look like we're going into recession? Then what does the Fed do? So I think that there's no cut and dry answer as to what bond yields do because of the stage that we're in the current economic cycle and because of the stage that we're in the current bull market in the stock market. I can't offer you out any crystal ball.
Mm-hmm. Would any of Trump's indications of protectionism on trade affect into this overall?
Just from what we've seen in the matter, in the span of one whole week, he's backing off most of the crazy things he said during his campaign. At some point, somebody rational is going to whisper into his ear that it's been a few years since China was manipulating its currency. He might need to wake up.
Yeah.
So I think that he's going to be highly aware from before he even sets foot in office of his legacy, and will try his best to avoid the recession that at some point in his time in office will occur, unless the rules of nature as we know them have all been revoked, which I doubt.
Yeah, exactly. And I guess turning to, you have strong opinions on various programs or initiatives that could be or should be implemented in the U.S. for economic development. In other words, what are the answers? Is it educational reform, regulatory reform, sound money policy, or even central bank government stimulus in the short run as a stepping stone to a more Austrian view? What are your thoughts in general?
Well, look, I think that there are three different avenues that I would take. And I do think infrastructure spending, by the way, is the way to go. Some of your prior guests have actually done a lot of extensive work into how to make a public-private partnership succeed without piling a lot of debt onto the public purse. So I'm highly encouraged by some of the work that's been done, and I hope that people on Trump's team see it and don't just drive up the debt. That being said, I think that the Australians have come up with some great programs for helping their students pay back student loans. They make them wait to begin paying until they've hit a certain threshold in terms of their salary, at which point they begin to automatically deduct a certain percentage of their income. And the programs that we have now are exactly the opposite. They encourage students to take on more debt than they can afford because they know that at the end of the road, there's an avenue that they can take for forgiveness. So I would go the opposite direction because we do not want to communicate to our children's youth, who will be our leaders one day, that debt doesn't matter. B, education reform. And I think that this will be one of the bloodiest battles. But again, had the Fed not made it so easy for Congress, I think that some of the more difficult tasks would have been addressed by now. And these do have to do with teachers' unions, pension plans, all of which have torn away at the fabric of our educational system. We will never be a global player again if we don't start to up our game when it comes to educating our children. I believe that very strongly. And then I would take another page out of the game book of the Australians and the Danes, and I would look to, in the event of recession, I would look to job retraining programs, which is where they have put money rather than simply expanding the social safety net and encouraging people to stay out of the workforce. Something, again, that cheap money has enabled. So those are kind of the avenues that I would take. They might not be the most conventional, but I think we have to be very forward-looking in terms of rebuilding the competitiveness of our country.
And perhaps also apprenticeship programs. Germany is quite big on that, 70%. I've heard figures compared to 10% in the US, in terms of doing apprenticeship programs for employers.
Oh, absolutely. All of these things make such a difference over the long term. And that's the key. We've become such a short-term, we have short-term-itis as a country, whether you're talking about, every 3 months we report earnings, or job retraining programs that take a long time to pay off. That's true, but then they pay dividends for a very long time as well.
And I think also the message from the U.S. elections has a large part to do with um, uh, regulations and regulatory capture in the economy, in terms of companies that would try to protect their own industry by making onerous regulations or additional regulations in protecting their company in the industry, preventing or making it more difficult for smaller entrants. Do you agree on that? Or?
Oh, look, had the default cycle been able to play out before QE2 came to the rescue, I think that we would have a much more competitive environment. But the fact is, way too many companies populate way too many industries. And I think we're paying the price for that now, in that it is so difficult to be a small business person in this country. Barriers to entry are so onerous. The regulatory morass has only grown over the last 8 years. And you've effectively stifled entrepreneurship in the most innovative country in the world. It's a shame. No, the big companies completely control their interests, and they stifle innovation at the same time, which is not the American way. It's part of why, here in Texas, for example, we have been the vast majority of the 9,000 companies that have abandoned California in recent years have relocated to Texas. It's with good reason, because we're one of the easiest states in which to conduct business.
Yeah, and also there's a international headquarters for innovation certification is based in Houston. We've actually set up the Canadian chapter for that innovation certification body here to help foster innovation in North America.
Huh. That's pretty amazing.
Yeah.
And I'm not surprised that it's in Houston. I mean, look, I think Houston's going to have a lot of problems over the next few years. They've got a commercial real estate situation in Houston that they're not going to be able to escape. But by the same token, I think the city's done a great job of reinventing itself. It's become a hub for the healthcare industry with MD Anderson, and it really has diversified itself compared to the last time we had a major decline in energy prices. But in the meantime, there's some yuck to come.
And given your views on economics, taking more of an Austrian school of economics approach, is there a path for the U.S. to move towards a more Austrian school-based economic approach to its economy? I mean, I guess does it make sense to go overnight, or is there a gradual approach, a gradual transition, migration plan, if you will? Does that make sense, with some initial Keynesian stimulus to get there and gradually going to more fiscal prudence and more of a savings investment-based economy?
My stock answer for you, Richard, is we can only hope. That's a tall order in a world that remains populated vastly by Keynesians, and unfortunately Keynesians who don't recognize the error of their ways. It will require the revolutions, if you will, because I think that's what we're really seeing reflected in a lot of these election results, Brexit here in the United States. It will continue, it will require that the revolution continues and makes its way all the way into the economics profession. And I can only hope and pray that that happens, because as you know, I'm a huge proponent of the Austrian school.
Well, great. We hope that can happen, and thank you very much, Danielle. Could you give an idea or some information on how our listeners can learn more about your work and to get in touch with you?
Oh, absolutely. Look, my website is www.DiMartinoBooth, that's a mouthful, .com. My Twitter handle is @DiMartino Booth as well. That's DIMA. Gift early. Set up the book that I've written, An Insider's Take on Why the Federal Reserve is bad for America. You can tell that my publisher was not shy at all in suggesting the subtitle, again, Fed Up, an insider's take on why the Federal Reserve is bad for America. And I like to joke that since the release date is February the 14th, that I'm going to send Janet Yellen a forget-me-not. So please come follow me, sign up for my newsletter. I'd love to hear from you.
Great. Thank you very much, Danielle.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.